Thanks very much for joining us. The JSE had a great year last year. Why was that? I mean, especially given that the world actually didn't have a great economy.
Indeed, Peter. This really surprised a lot of people, and in fact, you do hear a lot of people calling for a correction, and it's understandable because reaching all times like this trigger such views, such as there's likely to be a correction. What I actually want to get into is to explain that as much as people call for a correction, if you look at the JSE, in fact, the broad measure of our equities market, which is the all-share index, look at it from bottom up. You actually can see that as much as many people call for a correction, there is actually still value in the market. In fact, I'm going to illustrate with a number of sectors to show that approximately 50, in fact over 50% of the all-share index still has value. When you look at the top 8 stocks in the all-share index, which account for approximately 50%, you look at their PE, price earning ratios,
Right.
which is kind of a measure of whether a share is overvalued or is cheap or expensive.
Right.
In fact, you can see that there's nothing much to worry about. You look at Billiton, for instance, the forward PE of BHP Billiton, it's around 13. You look at the likes of Sosol, which is around 8.
Yeah.
Those PE ratios don't actually raise alarm bells. So
right. You know what, Dr. Bapel, I'm gonna rush you along, unfortunately, because we don't have a lot of time. I think we'll get into specific stocks maybe another time. But I was just curious, are we going to see another year where we have a 22, 23% hike on the JSE in 2030?
Our view is it might not be as much as that, but we still believe that the market is, over the short to medium term. In the coming year, for instance, we think the market is still likely to yield better returns.
Yeah.
It might not be as big as what we have seen in the past year, over 20%, but our valuations do indicate that indeed we are likely to see the market surprising the doomsayers.
All right. Without going into specific stocks, which sectors do you think will be the ones that will come through during the course of the year?
Exactly. When you look at the banking sector, for instance, they are trading at price to book of about 2 times. And they comprise 8%, about 8.5% of the all-share index. When you look at the insurers, for instance, which comprise approximately 5% of the all-share index, they also trade at a slight, Peter, I emphasize, slight premium to their embedded value. Remember, insurers are measured relative to embedded value. They trade at a slight premium, That shows that actually there's still value that can be derived from investing in the insurers. So insurers, banking sector, definitely there is value still there. Where one needs to apply caution is on sectors such as on retailers, for instance. Retailers are overvalued by our measure, and we think
so because the retailers did quite well this last year, you don't see that happening again this year. Very quickly, should people like me be thinking about shifting our monies and investing in the JSE a lot more than before? Because 22% return is pretty good, isn't it?
It's very good. Again, one needs to emphasize that past returns are not necessarily indicators of future returns. So what I'll really emphasize is you don't have to put all your money in equities. You still need to, I emphasize, you need to diversify. Get into bonds, get into money market, put some in the equities as well. Get a reasonably well-diversified portfolio so that whatever happened in any of the asset classes, you don't follow only that particular asset class. So diversification is key.
All right, we're going to have to leave it there, unfortunately, but Dr. Manas Bapela, Chief Investment Officer at Argon Asset Management, thank you very much indeed for your time, and I'd love to talk to him again about specific shares, but there you go. 22% return if you had invested on the JSE. That's not bad at all. Time to take a look at your indicator.